Hello, everyone. Before we get started, I thought I'd try to get an understanding of who's in the audience today. We're going to be talking about angel investing, and we have founders, we have investors, we have community members. So if you are a founder, please raise your hand. If you are an investor, raise your hand. So about maybe 50-50?
Hey, but it works both ways, right? In order to angel invest, you need one of each, at least.
There you go. And general community members, government, raise your hand. Okay. So we're going to have a good discussion today about angel investing. We have two amazing entrepreneurs and investors on the stage here, both in venture capital as well as in angel investing. And we're going to have them introduce themselves. And Marc, we'll start with you.
Super. Hey, good afternoon, everybody. I'm Marc Blumenthal. I'm one of the partners at Florida Funders, but I spent the first 30 plus years of my business life as a tech founder and built and exited two or three tech companies here that I built in Florida. And in 2015, went into full-time angel investing in venture capital.
Awesome. Thanks, Marc.
Yes, Steve McDonald. Similar to Marc, I started my entrepreneurial career around 1999, the dawn of the internet, Web 1.0, and built a couple of companies along the way, had 3 exits, one not so good, the other 2 were pretty good, and started early stage investing around 2014 and partnered up with the Florida Funders Group around 2017, I think.
Awesome. And Steve, maybe you could speak a little bit about why angel investing. Like what is the importance of angel investing and why did you get involved in it?
Yeah, I think angel investing is, well, number one, I don't have to go to school to learn anything more. I could just make a bunch of bad decisions without a whole lot of information. But it's super fun in that, as Tom Wallace likes to say, we get to surround ourselves with the best and brightest entrepreneurs and young people who are building the next generation of breakout companies. And what could be more fun than that?
Awesome. Marc, you want to add anything to that?
I would say that, there's a lot of reasons. I concur 100% with Steve and my partner Tom in that, angel investing kind of meets an emotional, intellectual need for entrepreneurs. Like if you were a founder once and you built companies, sort of the most valuable thing you can do post building your own company is investing in founders who are building their company. Quite frankly, it's the way we get our juice without having to build the company ourselves. And but there's also more to it. It is a real asset class, and if you do it properly, you can have certainty of outcome in terms of running a portfolio of companies and getting great returns. So there's that part too, and I do it for all those reasons. And if you have enough of them and you're thoughtful about the process, which we'll talk about a little bit today, then you will have venture returns. And that's a good thing.
Awesome. So for the investors in our crowd, Steve, when you're looking at doing an angel investment and even doing a venture capital investment, what are some of the things that you would recommend that people do look at, try to understand before doing it?
I think that this is the tricky part when people decide that they want to get into early stage investing. Oftentimes what happens is they know a friend of a friend or their daughter's best friend has a great idea, and people this is their first step in. And they don't really understand the market. They're really investing in the people, which is really one of the best ways to do it. But they'll make 1 or 2 investments and then they lose money and then they give up on the whole thing. The idea really should be to do your homework, do a lot of due diligence. The other thing that I did early on was I found out, I built a network of early stage investors who had actually made a career out of early stage investing. And I co-invested with them. I did that for several years. And then I got to learn the ropes of what the kinds of things that you should be looking for in those early stage investors. Does anybody see The Battle for Uber? Anybody see that? Nobody? It's all early stage. Have we seen that yet? Well, one of the things that's like a real driver is what gets people super excited are these founders that like they will just take the world by storm and nothing will stop them. And sometimes that's great, and that's what like these game-changing companies are built on. But sometimes as an investor, it can be a bumpy ride. And so for me, the things that I kind of look for is somebody that has like a tremendous amount of fortitude, has a really clear line of sight on the business that they're building, that they really clearly understand it. They can sell, they can understand finance, they have a good idea of the technology, but they're pretty well diversified, but they also act with a bit of humility, and they can be taught, and they're eager to learn and to grow that way. And so the final thing I look for is a really big, large and growing total addressable market. So those are the main things that I think that people should be looking for, and always do your due diligence.
Did you want to add anything to that, or compare maybe with venture capital investing, because you've done both?
Well, you know, I don't know that the fundamentals are different. I think they're identical. That, you know, they're blurred lines today. Angel investing is typically characterized by individuals putting money to work directly in the company or through a platform, whether that's something like Florida Funders or others that are out there. And, you know, venture typically is a fund is raised, and then the venture firm puts money into the company, right? And then Florida Funders happens to be a hybrid of those two things. But the fundamentals are the same. You need to not bet on one or two or three. You need to have a portfolio, and, you know, there are different lines of thinking, but some say 12, and some say 20, and some say 25, but it's north of 10 and probably less than 30 is the sweet spot where you have enough exposure to enough vetted deals. So some of those criteria that Steve talked about, making it through a process that probably they are 1, 2, 3, 5, 10% of the ones that you looked at in total. So just kind of think about the metrics there, right? Let's just say you did 10 deals over a couple of years. You've probably looked at 200. And you've done a thoughtful analysis, and you've met the founder, and you like the addressable market, and then you made the bet. And, you know, there's a really good chance that 1, 2, 3, 4 of those are going to work pretty well. And there's a really good chance that half or more are going to not work or not work at all.
Can you give an example of one that you may have invested in before and you had lessons learned because of it?
There's a few of those. Actually, you know, I think there's different measures of failure. Like, how do you measure failure? There's, you know, it could be just money, or it could be like time wasted. It could be frustration. Like, all of these different things kind of add up, and just at the end of the day, do you have more or less hair? And, you know, was it a good ride? And so, you know, one of them was like actually one of my biggest money loser was actually like from one of my best friends. And I kind of went in, we wrote a big check. I'd known him for a long time. The company was generating like there were $170 million a year in revenue, much later stage. But there was a ton of debt on the company. And because he was a friend, I kind of ignored that. And ultimately what ended up happening was the company ended up going bankrupt. And so we lost all of our money. Another one, and so to Marc's point, is you really, when you're making a decision to invest in an early stage company, you're really investing in the founder, not the company and not the idea. You have to invest in the founder. And I had one, it was a founder and co-founder, and this just happened over the COVID period, where one of the guys was in the trenches every single day. He woke up at 6 o'clock, went to bed at 10 o'clock. He did nothing but eat, sleep, and breathe the company. The other guy freaked out, and he went to Mexico and kayaking for a month, and he came back, and he's like, hey, I need to get out of here. I can't do this anymore. It was really great, and we were able to get rid of a bad founder, but those are the kinds of things where you spend a lot of time coaching people, trying to get them on the bus, and they just should never have gotten on that bus to begin with.
Speaking of coaching, what are some of the things that you've done with some of the angel investments you've made, Marc, in terms of coaching and helping them to move to the next step?
Well, you know, that's, it's hard if you've been a founder and you've exited and you're older, like I am, you do have you've made a lot of mistakes and you've had some success. So you want to try to help the founders that you're backing make fewer mistakes and hopefully create some phenomenal outcomes. So there's a lot of different things. A lot of it has to do with, you know, I like to say staying in their swim lane or sticking to their knitting. A lot of founders can spin up a lot of things and chase things, but if they're building, it's about that discipline of what it is that they're building and kind of thinking. And then, you know, I would say that in large part what ends up happening is when we sit on a board or we're a board of advisors or we're just on the cap table and we take the call or the email or the text, a lot of times I'm like the release valve. I'm the person they call when they're like trying to run an idea by the board. They're thinking about presenting to the board, or they're trying to figure out a problem with a customer or how to acquire, and they want to run it by someone. And I'm an empathetic ear. Is oftentimes what works really well for me. I've walked a mile in their moccasins.
Let's turn to founders. Speaking to the founders in our audience, what's some advice that you can give to them as they're going out and thinking about raising some money, maybe in very early stage and compared to later stage?
So I think for founders, you've got to have a really clear understanding of what you're raising the money for. So often that there's like this moniker of success that's like, oh, I did a $20 million round, I raised 10 or whatever. And then, you know, the prize is really how much I raised, and nobody really cares about how much of the company that they sold. And, you know, at the end of the day, after you've done this for a long period of time, it matters how big your check is at the end. It just really, you know, you did all this work, and then, you know, if you find yourself at the end, and maybe it was a great company, a great success, you're left with 5% of the company. That happened with me and my first company. And so, you know, you do all this work, and then it's not really the payout or the reward that you think it's going to be. So when you're evaluating raising capital, you got to look at it a couple different ways too. How much money do I really need? What do I need it for? What's the use of funds? And then are there other ways that I can think about financing? For instance, you know, Michael Dell famously financed his company because he had, you know, people would place their orders for those PCs. He would take a credit card. He got paid in 30 days, and it took him 90 days to build it. So he had an extra 60 days of working capital, which reduced the amount of money that he needed to raise when he was going out. So, you know, can you get your customers to prepay for your orders? Thinking about, you know, different types of financing, whether it could be, you know, your confidence level can you get a bank loan? Is it early stage angel? You know, making sure that you're getting the right amount of money at the right time throughout the growth of your business.
That's great advice. Marc, anything to add to that in terms of what you would recommend to founders who are looking to get investment?
I would say, to echo on what Steve said, I'd say one of the most challenging situations I've had with a portfolio company is they raised too much money at too high a valuation. And the cap table got radically complex. There were lots of personalities and levers, and they you know, it's pretty typical. Everybody feels really good when the money comes in and you've got the backer, but oftentimes you got to catch up to that valuation. And I would just echo that. More often than not, you're better off raising enough money and catch up to it quickly, as opposed to taking the larger amount of money and overspending and potentially having unhappy investors. I would say the only other thing is pick your investors, your venture firms and your angels wisely. It's unlikely that they're all going to be passive. Venture firm for sure is not going to be particularly passive. Some angels say they're passive and they're not, right? You've got to take the calls. So try to look for fit. Do they understand your business? Do they understand you? Is it congruent? Not all money is equal.
Awesome.
I just want to add one other thing. It's really super important to control your burn rate, especially in like right now with the uncertainty in the financial markets. You know, I was working with a company that, you know, every 6 months he's raising more money. And his burn was like, you know, $300,000 a month, and he, you know, you close a $20 million round, it gives him 6 months of burn. It's just not a way to run a business with just all of the uncertainty about having a startup, let alone, you know, the uncertainty in the financial market. So you got to watch your burn.
So we have a few minutes. I'd love to get a question or two from the audience. Anybody have a question that they'd like to ask either Marc or Steve from an investor perspective or maybe from a founder perspective? No questions.
How do you find your leads? Do you work with the universities, or do people come to you? You have a website?
Leads of companies, founders to invest in. Maybe the most difficult thing we do, and it is all of the above. To put things in perspective, at Florida Funders, we invest in about 24 companies, give or take a year. We have to look at almost 2,500 to do that. So name it. Emerge, universities, incubators, accelerators, everywhere. We have scouts throughout the Florida and throughout the country. It is the differentiator. Whether you're angel investing, like Steve's example, where he created this network of other successful angel investors and took off of their exhaust of deal flow. It's all about deal flow. So all of the above. And it is disproportionately exhausting, but that's how you find the gems to invest in.
Hi, Steve. Quick question. You talk about a lot about the importance of the founders. How do you feel about the number of founders? The classic teaching and belief is you got to have 2 or more compared to 1. How do you feel about 1 founder?
Well, as a solo founder, I'm kind of biased to solo founders. I had partners, didn't work out that well. So, you know, we parted ways, and I continued to grow my company. So, but, you know, it depends, right? So, personally, the number one issue I see in almost every single startup I'm involved with more than 1 founder is like the boardroom battles between 2 people. It's like if people could get out of their own way, they could accomplish so much more. But everybody seems to want credit. Like, you know, my brother-in-law, I love to death, went to business with my best friends, and they didn't have anything. They were just like, but they were always at each other's throat, bitching about, well, I did this and I did this, and I'm like, you don't even have any revenue. What are you yelling about? Like, you haven't done anything yet. So what are you battling over? You know, who's did what? And that's happened almost every single company that I work with that has co-founders. You know, sometimes they get through it, but I don't know. Personally, my experience has not been that great.
Hi. So, what is your why early stage, and what is your competitive advantage on investing on that early stage companies?
I'll touch on it and then pass the mic to Steve. I mean, there's a number of reasons. Early stage is really the most fun. It is also the most risky, but then it's the most rewarding, right? So, you know, you're really trying to judge the character of a founder or a founder team. You're trying to judge the size and the capabilities and how big a market is. You're trying to judge their strategy and their tenacity to change strategies when they need to, and then you're backing them multiple steps along the way. That generally means you're going to see, if it works, you're going to see 10x, 20x, 50x. If you go much later stage, it's usually 3x or 4x or 5x. And frankly, it's a lot easier to judge a company after it's doing, say, $50 million in revenue and has $10 million in EBITDA. I'm not suggesting that the people who do that aren't brilliant and don't do phenomenal at it. They do, and I'm an investor in some of their funds. But that's not my joy to wake up every day and do. Steve?
Yeah, I think I agree with that. I think, you know, Marc said it earlier, you know, how do we get our juice? And everybody is different. Some people like the more predictable outcome of a later stage investing. I don't gamble except for this. And so this is my blackjack table. And I love getting in early enough so that maybe we do have, Mark's got a 300X right now. I don't have a 300X, but I'm working on it. So that's, you just don't know, and that's the fun.
I would add this. It's important if you take money from angel investors or even a family office or a firm that's an investment firm, but they're not used to this asset class, unless it's the difference between life and death, don't take their money. They're going to get scared and they're going to react negatively. And if there's a covenant in the investment agreement that's going to drive you nuts or send you off course, they're going to pull it. So you should find people like me and Steve, as crazy as we are, who are willing to bet it all. And if you lose our money nobly, right? Meaning you're working your tail off and you're doing everything you can, we're prepared for that. You want people who are prepared for that.
Hi, thanks a lot for your time today. So you both created startups and then have exited those as well. I was just curious how important it is to be an angel investor or be a founder before launching your own VC, your first VC fund.
I couldn't imagine doing that without actually having the real day-to-day experience. There's so, Mark and I were parts of these, they're called CEO group roundtables, right? So we would meet once a month, and I did this religiously for 7 or 8 years with other groups of people, with 8 other founders. And the learnings that, all 5 out of those 7 had 9-figure exits. And I don't think that's accidental. I mean, we learned so much in that period of time. I had my last company for 16 years. Just the operational experience that you get and the deep learning, about financing, marketing, sales, leadership, sales management. That stuff you cannot read in a book. You got to live it. And I cannot imagine trying to, because once you do that, you can kind of you start to recognize patterns in people and in situations. And so without that pattern recognition right now, I would not be able to make the investments that I do.
And I would say you can bring partners in that have that experience, but I would also say for those of you who are younger in the audience, I started my first company in 1984. The fundamentals of business haven't changed. The tech has. The generation of people who are in the workforce has. The fundamentals are virtually identical. Those fundamentals that Steve talked about, if you can't do those, it doesn't matter what kind of business you have. It doesn't even matter if it's Web3. The fundamentals are the fundamentals of a team.
Hey guys, thanks for taking your time. When a company raises a series of investment and you guys decide to invest in early or mid stage, not so much late, but it'll probably apply. When the money's going towards it and you do your due diligence, where do you allocate that capital? Do you guys have, of course it's based on every business. For instance, they're budgeting for, inventory or marketing or, employee, hiring people. What kind of things go into where that money's allocated?
So let me see if I can restate the question and see if I've got it right, because I'm not sure that I do. Are you asking about when we make a commitment to our first check into a company,
Sure.
right? Whatever series that is. You're asking how we apportion that, or are you asking how we reserve for the next round?
I'm asking how you apportion that funding.
We don't.
Okay.
If the founder doesn't have an idea and hasn't presented a viable use of funds plan for the entire round, not just the capital that we're writing, but the capital that they're raising from any other funds, then we're not going to do the deal. But it isn't, we're a minority investor, right? We don't take control of the company. We don't want to. So it's up to the founder to decide how much goes into headcount, marketing, R&D, and everything. But we're going to evaluate the efficacy of what we think that founder's plan is, but we don't apportion it at all. Steve?
Yeah, no, I totally agree with that. We don't, we really depend on the founder to have that insight in their business and what they recognize as their, as their weak spots and where they want to make the investment. Certainly, when we go into those situations, we try to use our experience and maybe to guide, to give some insight. Maybe, that the founder has some blind spots that they don't necessarily see that we can help eliminate. But for the most part, they have to have a pretty clear understanding of their business enough. And it's their recommendation, and just really, it's just our job to just nod our head and hope they don't squander the money and
So I
parties.
was given the 2-minute warning. We're going to have one last question here. I know there were other people who had questions. Florida Funders booth is over there if you want to come talk to us, and we can answer those in person. But one last question.
So just a quick question. Other than the founder, what would you say is the number one reason for you to invest in a company?
I'll say, I think it's the market and their ability to acquire that market. Whatever the total addressable, service addressable market is, and the way do they have a superpower or a strategy to acquire customers without a ridiculous customer acquisition cost. The thing that usually blows up an optimistic founder is their CAC, their customer acquisition cost is out of control, and it just burns money like nuts. And some of the best companies that we've invested in, the founder figured something out, or the team figured something out, and they had really low CAC, and they were able to accelerate through that CAC. And I would say, there are many other things, but usually the most expensive thing they do is acquire customers. So I'd say that's next in line for me. Steve?
Agree with that, but I would just say number 1 founder, number 2 founder, number 3 founder. But to Mark's point, it's still the founder, but what kind of unique insight do they have that nobody else has? And so we're looking for that. And the other is, it has to be a really big market, because even if a florist is found, they may be the best florist in the world and they have like some super unique insight, it's still just, a corner shop, and we're not going to do that.
Well, thank you all for letting me put you to work for this session, and thank you to Marc and Steve for sharing their insights.